Hello everyone, I'm Susma Thapa along with my group member Meera and Devendra. I'm going to present on the topic demystifying profit accounting versus taxable income in Australia. So in this presentation, we have included this topic. Here, I have highlighted the importance of understanding the accounting income and taxable income differences for a business. In strategic planning, recognizing disparities between accounting and taxable income is crucial. This distinction informs financial strategy, aligning short term reporting with the long term tax consideration. Compliance and reporting benefit from understanding these differences, ensuring adherence to accounting standards and tax regulation, fostering transparency and meeting legal obligation. Moreover, business can enhance tax efficiency by identifying legal deduction, credit, and strategies to minimize tax liabilities. Moving on, we have investor confidence, risk management, and operational efficiency. By integrating accounting and tax consideration, business streamline operational efficiency. This alignment facilitates optimal resource allocation and informed decision making. Understanding the difference between accounting income and taxable profit empowers organization to navigate financial complexities seamlessly, fostering a harmonized approach to operational strategy. This holistic perspective contributes to improve the overall efficiency and agility in adapting to dynamic business environment. Here we have also listed few questions like how do accounting income and taxable earnings fluctuate? Is the income tax fee for accounting duration the same as the income tax payable at the given of that period? Does the incurring a loss for tax purpose cause the recognition of tax related assets? Moving on, we have topic accounting profit versus taxable profit. Accounting profit is governed by GAAP, showcases a company financial health on the income statement guiding strategic decision. In contrast, taxable profit shaped by the tax laws determine the income subject to taxation, impacting a company's tax liabilities. Understanding the vital for this holistic financial management, compliance, and the strategic planning. Moving on, we have the key differences for timing differences, tax deduction and credit, deferred taxation, valuation allowances, amortization discrepancies. Understanding timing differences, permanent disparities, and tax deduction is crucial in managing accounting and taxable income discrepancies. Addressing deferred taxation and the valuation allowances ensures a comprehensive financial outlook. Additionally, navigating amortization discrepancies arising from varying schedules is vital for aligning accounting and tax practices, fostering accuracy, compliance, and effective financial planning. Thank you. Now I'd like to hand over the rest of the slide to my friend Meera. Thank you.
Thank you, Susma. For the more clarification, let's go through the Companies Act's case study. At first, let's talk about Companies Act scenario. Company Act's a chief retail chain reviews an accounting earnings of $500 million for the year. Let's explore a few potential differences that would lead to a different taxable earning. Timing difference. Companies Act uses improved depreciation for tax purpose. It's putting $20 million extra rate on its tax return than on its financial statement. Permanent difference. Interest on municipal bond. Companies Act hold $15 million in tax exempt municipal bond producing profit now, not situation to companies' profit tax. Tax deduction and credit. Research and improve. Companies Act invest heavily in research and development, qualifying for $30 million in tax deduction, no longer mediated in its accounting cost. Calculation. Accounting earning is $500 million. Timing difference is minus $20 million. Permanent difference is $15 million. Tax deduction is $30 million. Total earning is $405 million. From the above given data, Company's taxable income is $405 million, which is lower than its accounting income of $500 million due to the blended result of timing variation, permanent variation, and tax deduction. Now, let's talk about income tax expenses versus payable. It can be more clear from the given content. Income tax expenses. Calculating profit tax expenses entails estimating agencies' tax legal responsibility primarily based on applicable rate and rules im- impacting its imported profitability recognized on the profit declaration. This expected tax liability informs stakeholders that its anticipated impact on the business enterprise monetary overall performance. Strategic tax planning saves the estimation of tax legal responsibility. Regular opinion and modification of predicted tax liability make sure a more accurate representation as commercial enterprise instance evolve. Now, let's talk about income tax payable. Income tax payable is the sole tax legal responsibility decided after a thorough example of the final tax return. Serving as the verified tax obligation, it indicates the legal duty to remit the determined amount to the government. Confirm tax liability in profit tax payable without delay influence shareholders' price affecting inventory prices and investor perceptions. The connection among earning tax payable and deferred tax liabilities is evident in reconciling transient variations, showcasing the interaction between present day and the future tax responsibility. Let's continue. Distinction between estimated and actual tax liability. Income tax expenses, estimated tax liability, contemplated in profit tax price is a projection made all through the accounting duration. Income tax payable, actual tax on based on the final tax return denoted by using earning tax payable is estimated and due to the authorization. Impact of timing difference and financial adjustment. Income tax expenses. Timing difference include recognizing positive fees earlier for tax purpose can create various among expected and actual tax liabilities. Income tax payable. Final charge changes in the course of tax submitting system addressing discrepancies in earning and deductions make a contribution to the reconciliation of predicted and actual tax liabilities. Now let's talk about importance of considering both for the financial reporting. Income tax expenses measures accurate monetary reporting necessitates a complete knowledge of both anticipated and real tax liabilities, whereas income tax payable consider both aspects guarantees that economic statement aligned with the real tax responsibility, providing stakeholders with a particular depictions of the agency monetary health. Now let's talk about profitable company, no tax. It can be more clarified by highlighting the given reason. Tax deduction and credit. Profitable organization leverage deduction and credit to lessen their tax burden, carrying forward losses by utilizing losses from preceding years. Legal tax haven strategies, companies hire reason techniques in application just justification to lessen tax obligations, green initiative and sustainability credit where environmentally pleasant practice qualify for credit, reducing taxable profit, utilization of tax advantaged accounts. Wise use of accounts like retirement fund contributes to lower taxable profit and charitable contribution like philanthropic brings tax deduction lowering instant tax payable. Now I would like to hand over to my friend. Thank you.
Let's talk about the tax losses and the future. Tax losses definition. Tax losses occur when a company deductible expenses surpass its taxable income. These losses are natural part of business operation and can result from the various factors. Importance accurate financial reporting. Accurate financial reporting recognizing tax losses is essential for prices financial reporting. Companies must transparently account for these losses to comply with tax policy and provide accurate financial statement. Complaints probably handling tax losses ensure adherence to the tax regulation and avoid penalties. Complaints uh, long-term impact long-term impact understanding the long-term im- implication of the tax losses is crucial in informs sustainable financial planning and helps companies navigate challenges if effectively. Sorry. Tax assets definition. Tax assets stem from accurate tax losses. These assets are valuable resources listed on the company balance sheet. They serve to minimize the future tax liabilities. Strategic benefit. Reduction tax obligation. Companies strategically use tax assets to minimize the tax payment, enhancing cash flow. Uh, proactive approach. Proactive approach by integrating tax assets into financial planning. Complex companies exhibit a forward-thinking approach to the responsibility. Resources allocation, decision making, and resources allocation benefit from considering tax assets. Tax rate changing and deferred taxes. Significance. Recent tax rate adjustment impact financial statement. Companies must recal sorry recalibrate deferred taxes to accurately reflect their post-tax adjustment status. Sorry. Accounting standard. Adhering to the accounting standard ensure consistency and credibility, tran- transparency, and ali- alignment with norms guide companies through tax complexities. Strategic tax liabilities management. Seeking expert advice. Companies should seek professional advice to manage tax liabilities strategically. Minimizing tax burdens. Informed choice helps minimizing tax bonds. Balancing financial health and companies legal strategic versus tax events. Optimization. Rather than reporting to the true tax havens, companies can optimize the obligation legally. Risk management. A profound understanding of accounting norms inform strategic planning and risk management. In summary, the integrate transparent accounting and taxation required commitment to integrate beyond mere companies by strategical handle tax losses and leveraging tax assets. Companies can navigate financial complexity and make informed business decisions. Uh, these are some conclusion. In conclusion, let us navigate the economic trends with knowledge, make informed decision, and seek professional guidance for a resilient business future. Together, armed with understanding and strategic acumen, we can confident steer our organization towards success in every evolving business landscape. Strategic planning and threat control gain from a complete grasp of monitoring implementation. Let's negative the economic trends with knowledge, make knowledgeable decision, and are trying to find professional steering for the resilient commercial entrepreneurs future. These are some reference we put our group assessment. These are the reference. Thank you all.